Got Mark Tepper here, the Strategic Wealth Partner, President, CEO. No longer AAA.
Yep.
What do you think?
Well, look, I think as you kind of alluded to, I think Moody's is probably next in line to follow suit with S&P and Fitch. We are in a world of hurt right now. I mean, we're talking about $32 trillion in debt. We're still running a deficit of like $1.5 trillion per year. We haven't run a budget surplus since 2001, I think was the last time. And we are now in a situation where this time actually is a little bit different because 50% of that $32 trillion needs to be refinanced in the next 2.5 years at much higher interest rates. So whenever interest expenses as a percentage of tax revenues crosses above 14%, we are knocking on the door right now of 14%. When it goes above, the market forces austerity. And that's exactly what's happening.
Fitch called us out for more, right? They reminded me of like the exasperated parent who just said, I can't believe you kids.
Yeah.
You can't get your act together. You can't resolve these crises. You're always on the verge of shutting down. You spend like drunken sailors, you know, the whole 9 yards. And they just finally said the hell with it. Yeah. Now, we are still a haven for the world and money that comes into the world.
Yeah.
And we were and have been since, you know, S&P pulled this a dozen years ago. So will that change?
I don't think that is going to change at any time in the near future. I heard Shah Gilani talking about, you know, I am concerned in the longer term about the dollar losing its reserve currency status. I've never lived during a period of time when the dollar wasn't the reserve currency. I don't want to learn what it's like. We're going to lose a lot of those special privileges and benefits that we've had along the way. And there's a cachet that
comes with that. If you're sort of like the big draw, your currency's the big draw, and then you're not, then all bets are off. So let me ask you a little bit about where you see this going, because the administration, of course, has been touting the fact the economic numbers are improving. We've had a dozen inflation reports that have steadily gone down.
Yeah.
Still high, but not nearly as high as it was. And they're planning to unleash that in September when it's about the economy and things picking up. What do you think?
Well, look, the economy, without a doubt, if I look at all the different economic data points, the economy seems to be relatively healthy, with the exception.
So you're not in this recession camp?
I am. I was expecting it by the end of the year.
Because Fitch is saying by the end of the year we could be looking at it, latest the first quarter next year.
So I think first, second quarter of next year.
Really?
I've kind of pushed it out a little bit. So the Senior Loan Officer Survey, which measures bank tightening standards as it relates to lending, that is highly recessionary right now. And if we go back to 2007, at the end of 2007, the Fed was talking soft landing. They thought the housing crisis was not going to be a crisis. Every single economic data point was surprising to the upside, except for the Senior Loan Officer surveys. And when banks tighten credit, job losses soon follow. Within 2 months into 2008, we were now in a recession.
But sometimes they don't even have to tighten credit if consumers say, Namas, we don't have any more money to play with or not as much. Of course, you're not seeing it, you know, in a lot of traditional things like still packed planes, still packed cruise ships, still packed hotels and all of that. But it might be on its last spurt, you think? Or what?
You know what, though? There's one thing that's kind of underappreciated in this market rally, and that is the fact that savings accounts are now paying a risk-free 5%.
Yeah.
Okay, so
that's competition for stocks right there.
Right, and that equates to $20 billion a month in excess spending available to people that have accumulated savings. Now, that's not going to help the bottom 20% of earners who probably don't have a lot of savings. But for the people, you know, maybe in the top 50% who have money in money markets and savings accounts and not everything in the stock market, that is certainly a tailwind for them to spend.
Yeah, and you got the full protection of Uncle Sam behind it. So 4 or 5% versus a market that can get kind of a little volatile.
That's not a bad deal, is it? I mean, especially given the risk reward that we're looking at with stocks right now. Yeah. I mean, yeah, it doesn't hurt to rethink the asset allocation mix.
God, and that's a young guy saying that.
I think I'm considered middle-aged
Jump
now.
into money market. There you go. All right, thank you, my middle-aged friend, Mark Tepper. Not.
Hey, Sean Hannity here. Hey, click here to subscribe to Fox News YouTube page and catch our hottest interviews and most compelling analysis. You will not get it anywhere else.